Hey guys, can you guys hear me?
Yeah, you're coming through well. Can you
Great.
test Angela?
Yes, I'm here. Can you hear me?
Yes, I can. So welcome everyone to our first annual Ideate Innovate VC Symposium. My name is Boris Moisten. Many of you know me through Relentless Venture Partners, my new venture fund. Some of us may know me through Black Women and Black Men Talk Tech. Others may know me through Management Leadership for Tomorrow, some from Black VC. So welcome. The purpose of Ideate Innovate is to really help our ecosystem broadly focus on how do we get capital to overlooked parts of our ecosystems, our economies, our communities to help uplift people, right? And I think one of the key ingredients is the venture capital community. And there are, over the last 2 years, a rise in new venture funds. Many are doing extraordinarily well. A lot of talented people are trying to solve some complex problems. And still, it's not simple or easy to start a fund. There are huge barriers, multiple types of barriers. And like many of you, I belong to these different resource groups that gives us insights on how to launch funds. But, there's some nuanced data out there and information that we all need to share with each other that makes the process easier, right? So right now we're going to hear from, traditional U.S. banks and the role that they typically play, and from a major asset allocator in the role that they play. Later, we're going to hear from the U.S. Treasury Department or an employee of the U.S. Treasury Department to talk about what they're doing. And then the Treasury generally works through the states. So one of our state employees that's working on economic development to talk about how they're thinking about rolling out their programming to inform all of you what you should be looking at with your states. And hopefully we'll get some resource links that you could click on if you're not in New York, and you could find out who the person in your state is that you need to be getting in contact with. So with that said, let me kick off our first discussion around, LP funding for venture capital funds. Having a conversation with, traditional banks here in the U.S. and with asset allocators. We have George Akil, who, as of this date, is formerly of B of A. And I'll let George Akil talk about what he did that was so revolutionary at B of A and what other banks are doing now. And I'm not sure if he could talk about his new home, but he's been given a ton of responsibility. And I'm sure part of the work that he's going to do is to formalize a program similar to what he helped roll out at B of A. We have, and I'll have you introduce yourself in a second, George, Akil George. And then we have Angela from Crucial Partners. And they are an advisor, consultant, and investor. And, together we're all going to talk about what we look for in new and unconventional fund managers, what some of the pitfalls are. We're going to talk about what they're doing to allocate capital and what they look for, so you guys can sort of understand what developing a relationship with an investor is like. So having said that, Angela, I'm going to unmute you, but why don't you talk about, introduce yourself and talk about Crucial Partners.
Sure. Thank you so much. And thank you all for being here and for inviting me. Crucial Partners, this is an investment advisory firm. We're located in New York City. We have one office. We're about 65 employees, and we advise all nonprofit organizations. So we don't have any pension plan type clients. We're known as experts in the nonprofit, and particularly in the endowment and foundation, otherwise known as the E&F space. We have a simple, very simple business model. It's pretty much an all cash business that includes advisory services over building portfolios. So we look at asset allocation, and our organizational goals involve circumstances around risk tolerances, and it sort of culminates into asset allocation and asset allocation framework that we detail in the investment policy statement. So we examine that, we edit that, and we make recommendations based on that policy. We understand the community foundations in particular and their needs and that they're subject to specific parameters in terms of liquidity, available cash. We pay attention to spending plus CPI, and that's it. And then we build portfolios from there. We've been around, I think I said, since 1980. I was onboarded around 2016 to accelerate and expand our work that we have been doing in the diverse manager marketplace. It actually started back in 2013 when a client asked us, how many diverse managers do we have in their portfolio? And are we spreading them across our client base? So the first thing that I had the great autonomy to do was to just go out and partner with various trade organizations that was focusing on diverse managers across various asset classes. So I began sourcing to include hedge funds managers, fixed income, US, non-US, and all across private equity to include venture. Those relationships have been really, really great for us because they help us to leverage many resources. I get to source diverse managers across the nation. I do have some colleagues that source outside of the US, but it's important to also know that all of our clients are US based. And when it particularly comes to venture, since this is the conversation, there's so much work to do at home, meaning here in the US, that we love to, many of our clients love to be vision and value aligned. And we think that there's so much work to do that we want to allocate, I think, more to US based venture capital funds and firms. However, prudent diversification involves geography, investing outside of the US. And for us, it really includes age, ethnicity, different backgrounds, different life journeys, which we have called or referred to as variant perception. So it's very, very important to think about diversification in many ways. And the bottom line is that at Crucial, we want to build better and smarter portfolios, and we don't understand why inclusive capitalism is not included in that framework. We have it deeply embedded in our investment philosophy and research process. And I'll just stop there.
Awesome. And Akil, I think you have an interesting story to weave in here, because I know you as the guy who's working in strategy under, the CEO of B of A to help put together and to work with your principal investing group to look at the diverse market to get funding to diverse fund managers. So would love to know what you did there and what you're up to now, if you could disclose it.
Yeah, sure. So again, Boris and team, thanks for having me, and welcome everyone. Pleasure to be here. Akil George, in my former life at B of A, I worked within the global corporate strategy team. Within that team, we were responsible for pretty much allocating $300+ million to minority VCs. Minority is defined by Latinx, Black, Asian, or women. So across that spectrum of, I guess, VCs and GPs, that's where we allocated a lot of our capital. A lot of this came out of, I guess, if you think about a bank's remit, there's the Community Reinvestment Act, where we service communities and clients, of underprivileged minority backgrounds. However, we realized that, it's not just a bottoms-up approach, but we also needed pretty much a top-down approach. There were a lot of minority-run or minority-backed companies outside of the small business realm that didn't necessarily receive an appropriate amount of capital. And this is pretty much where we stepped in. So we partnered with the investment banking team, and I connected with Boris on LinkedIn. Whatever source whatever pipe source or pipeline that we had to pretty much start pumping out a lot of the capital that we had into an ecosystem that we believe would offer not just first but second level results. And I say that from the perspective of, yes, we're funding minority run venture capital funds, but we also ask, and when we conduct interviews with GPs, that they also, pretty much allocate funds to minority run businesses as well. So, we definitely see some second order impact from our initiative. Currently, unfortunately, I left that program, but I guess there's also another opportunity. I'm currently at Citigroup, where I'm tasked with, leading their wealth management strategy. I do have some partnerships here, and I do plan on working a lot with the City Ventures team, which I would say is, I guess, a peer team as opposed compared to the Bank of America Global Principals Investments team.
Yeah, your counterparts.
Correct. And I'll just have that conversation with City Ventures to figure, given the success that we had with that program, is this something that, you guys are interested in undertaking? And hopefully we can get something started here at City.
Yeah, so Akil, let's tell us something we don't know or understand that's not obvious to everyone about capital that bank has. Like historically, before the financial crisis, we didn't have the Volcker rule. We didn't have to put a lot of capital aside for investment losses to the extent that we do now, right? These banks are, I don't want to say bulletproof, but very well padded. And that's why a lot of the hedge funds came on the scene 20 years ago or so, because they could no longer do a lot of the freestyle investing they wanted to internally at banks. So they all spun out. And banks have been a little bit more secure since with risk taking. So when they invest in things, they generally have to look at the Volcker rule and hold capital against the risk that they're taking. There is an exemption for that. And I think a part of that plays into how your program rolled out. Some of it is community reinvestment, but that's the Volcker rule exemption is pretty interesting. Do you want to talk about that a little bit? Where all the banks benefit from?
Sure. So just to give some context, coming out of the great financial crisis, a lot of banks were involved in prop trading, i.e. trading for their benefit. Volcker rule was introduced in and around that time to prevent banks from unnecessary proprietary trading. If you think about it, we are investing in a VC or hedge fund type strategy, just presented its risks. And in the case of the financial crisis, can, bring down an entire institution. However, within this venture capital space, although it technically it would violate the Volcker rule of prop trading, there is an exemption, and a program like this offers that exemption. That's because of the social impact that investing in something like this has. So we are allowed to engage in proprietary activities with certain venture capital funds, provided that they meet certain venture capital restrictions and obligations, i.e., whether it's being minority run, having a social and ESG impact, or, having a mandate of serving a minority or underserved community. So it was because of those exemptions. And again, a lot of these exemptions were carved in under the Obama era, but it was, an initiative with political aspirations for pretty much having entities with big pockets, mainly big banks, give back to these underserved or minority communities.
So the big insight we're taking away from here, guys, is that banks are using their own balance sheet capital to invest in funds, and they have, I want to say, an economic benefit to do funds that are doing social good, or ran by overlooked parts of people who are from overlooked parts of our community. So this is an area, if you haven't looked, where you should be looking. We know that most banks, and I'll let Akil talk about it later, or Angela ask some questions about it. B of A has built a strategy around it. Most banks do it from time to time and benefit if their principal invest in something that gives them an exemption. They don't necessarily have a program built around it. So I think that's one of the things we just heard Akil say he's going to try to work on at Citi. And so let's move the conversation on now to an asset allocator like Angela. Angela, when you're investing on behalf of your clients, or advising them to invest, particularly when it comes to the private allocation, the alternative allocation, more specifically with venture, how do you go about thinking about investing in new fund managers and fund managers with unconventional backgrounds?
So I know that we built a special process around this, and that really entails hiring a person, and that person is me, to focus on accessing the talent. And so I've led that work, but now, as I said earlier, it's core and central to our investment philosophy. So every single analyst at Crucial, and we have a team of about 22, 24 individuals to include our consultants. Everyone does this type of sourcing, but I still have great oversight in terms of getting individuals through our process. So the first thing we look at is differentiation. We like things and people that are different. We gravitate towards individuals who are building something different or think of investing in a different way. So we look at correlation, uncorrelation in terms of who's in the pipeline, what's alike or different in terms of the funds that we've allocated to in the beginning. But the first thing we look at is the models that we have with our clients. Some may not even have exposure to venture. Last year, we've worked, and we will continue to do this work, to increase the asset allocation in the private equity bucket so that we can make room for new opportunities and new ideas. So some are over allocated, so that could be an issue. Some have concerns, and so do we, about vintage year diversification. So making rooms in those portfolios is really key. But the way we approach this work is, first of all, we don't want to conflate emerging manager programs with our diverse manager research process. And we never wanted to call it an initiative or a program, because programs end. And so we wanted sustainability, and we wanted repeatability in terms of who we are including in our process. And my job is largely, and was largely initially, to just make sure that we have a fair process, and that the playing field is level, and that the goalposts are not constantly moving in terms of what managers need to achieve. So to your point or question, we were seeing, or continue to see, a lot of venture capitalists enter the space with non-traditional backgrounds. And so we asked the question of every manager: what's your edge? How are you different? How are you thinking about investing? How did you even, come to be an investor? How are you building your track record? Is there a track record? Did you spin out of a top tier firm? How did you enter the space? Because then that informs us in our meeting. And when we're getting to know you, you can start from anywhere you want in terms of introducing yourself. You could start from birth if you like. That informs us who you are as a person and how did you get to the type of investing that you do. We are biased towards operators. So if you're an operator, a serial entrepreneur, we like to see that. And then we want you to be very thoughtful about portfolio construction, follow-on investments. Do you set milestones for your portfolio companies?
Yep.
We tend to gravitate towards funds that are concentrated. The smallest fund that we will invest in is probably around 25 million. And we write a lot of small checks. We have about 124 clients to date. And I forgot to mention this early, or we manage about 34 billion on behalf of our nonprofit clients. You'll see in our latest, actually our old diverse manager report, and a new one is coming out very, very soon, that we allocated 4.2 billion of that 34 billion to asset managers, to include women and people of color. So when you disaggregate the data, and you'll see exactly how much we're allocating to white women, for instance, Hispanic people, Black people, and then Asians, we can see exactly where more work needs to be done. But it really starts out with what I call triage, seeing how credible you are, your track record or lack thereof. We're good at building track records and piecing things together through reference calls and talking with other LPs. And we're not the type of LP that will sit on the fence and look, what others are doing. We come to our own conclusions through our analysis and diligence work. So we allocate significantly once we see that you've executed the strategy, or you are a firm that's ready for institutional capital. That's really key. And the last thing I'll say on this is that we care very much about representation, looking at individuals who are underestimated and undersourced, but diversity is not just the only metric that we look at. So I always tell early managers that you are competing against legacy funds and those who have spun out, those who have executed certain strategies over and over again. And so that's the hurdle, but we're not afraid to be first.
Excellent, excellent. Thank you. And Akil, could you talk about what you looked for in diverse managers? Because you went from a strategy guy to someone who has helped lead funding for multiple new funds, and everyone's been talking about the B of A guy. So I think I was happy when I think it was I forgot who put us together. Nazir, probably with Zeal.
Probably. Yeah.
Sort of made the connection. He was like, "This guy's going to change it for us." So you want to talk about what you what you looked for?
Sure. So a lot of the funds that we have invested in are first-time funds with first-time managers. So the first thing we think about is, one, the people agenda. So very qualitatively, we think, just what's your story? What's your motivation? So, I mean, using Nasir and Zeal as an example, necessarily, a lot of these fund managers had fund experience before in some capacity, whether in-house at, I don't know, some of the bigger shops, Samsung, etc., where they actually had a venture capital arm and they were maybe analysts or associates on those teams. What's your motivation for doing something like this, taking fundraising and launching a fund by yourself? In some instances, we do find that, it's financially motivated. We look for something that's, a little bit more passion-filled. And we usually see that in the investment thesis. So a desire to, fund minorities, a desire to service underrepresented parts of the population. So very qualitatively, we start looking at, the people agenda. Second thing we usually look at is, and as Angela mentioned, what differentiates you. It's not just the fact that you're a minority, but as she also mentioned, you're competing against legacy funds. So what differentiates you? And it's fine to have, a niche focus, but we also look for a keen ability to understand the niche sector that you're playing in and what gives you that edge, whether it's a focus from an academic perspective that gives, institutional knowledge, or, personal experiences, but what's your differentiator? What gives you your edge? Do you have a unique pipeline? Do you have, unique exit strategy? Do you have that, that innate knowledge? And we've worked with people who little VC experience, partnered with someone that had a lot of VC experience, but were PhDs in AI. So they understood from a technical perspective, that particular ecosystem. So besides the people agenda, we have differentiator, what helps you stand out. And then we go through a little bit more of a rigorous process, trying to understand, one, the pipeline. So understanding where you're going to source your deals from, your connections, and I keep using this for this ecosystem, because again, if you use the funnel example, you're going to get a lot of things. A lot of people are going to have good ideas, but as you filter those down, we are trying to understand where you're going to source a lot of this deal flow from. And the other big thing here is just understanding your investment process. As individuals, we innately have our biases, and we always encourage, especially new fund managers, to hire a board, have advisors to necessarily help inform. They have a lot more experience. And I threw this concept out, and I'm very fond of it now, but this sense of intellectual purity, where, you have a board, a very diverse board, whether it's an age, whether it's experience, gender, and I think having a really diverse board helps you look at things and problems from different angles and different perspectives. And these things kind of shine through in the investment process, from sourcing all the way to actually deal execution. And we look for usually rigorous, a rigorous investment process, whether it's in the form of interviews, someone with a strong financial background to understand, the companies that you're actually going to invest in, etc. And then lastly, I guess, serving communities. Again, as mentioned initially, we're looking at not just investing in the VCs as one step of, contributing to the minority and especially Black community, but who do these VCs then invest in? We look at, them targeting, again, minorities and minority communities, minority-run businesses, so that, again, that's more or less paid forward. So again, just a quick recap: people agenda, what differentiates you, looking at your overall pipeline, ability to deal source, in rigorous investment process, and the utility of an advisory board or a group of advisors to kind of help with deal sourcing and deal
evaluation. Yeah. So I'm going to be a little vulnerable here because I am currently raising a fund. I currently have a deal pipeline in companies that need to be funded. I'm expected to lead a deal right now, and I was up at 7 o'clock doing a call with the Sovereign Wealth Fund in Abu Dhabi to see if they're going to participate in this transaction with us. And at the end of the day, I'm one of the the main lead right now, and I have to be able to come up with funding. And you go through this process with creating relationships with LPs. And the frustrating part for many of us is how do we close the deal? But more importantly, how do we build relationships with LPs? I think as a new fund manager, not expecting or not knowing what the process will be like, you're thinking, oh, this is something that could happen in 6 weeks, but that's not the case. Angela, do you want to start and give some insight into what it takes to actually build relationships and to build credibility just from a personal standpoint? Because I still feel that this is a very personal business.
Oh, absolutely. It takes a lot of social capital. Sometimes it takes off the beaten path sort of meeting. So not being so formal in meetings and taking the meeting outside of, I don't know, the normal environment or the conference room, so to speak. I remember one of my best meetings was with actually a public equities manager out of Chi-Town, Chicago, Illinois, rather. His name is William Hurd. And we were in some sort of networking event after the conference in some sort of pub, and there were a bunch of hedge fund managers there. And I really got to know his mama, his grandmother, that he's a Christian, and we just vibed and we just talked. And that informed me of a lot of things with respect to, excuse me, who he is. And so I like to do that a lot. I actually reserve my Fridays for a lot of introductory calls, just vibing and getting to know people, because it is a relationship building business. And some people take longer to get there compared to others. If you look at emerging managers in the public pension plan spaces, their processes could take, I don't know, I've heard something really scary from one allocator. It could take 2-3 years before they get comfortable to get to know you.
We're fun too. Come back, but let's have a meeting every month.
Mm-hmm. And so I'm proud to say that with Crucial, our process is shorter, but it also entails a lot of things, and it's a lot of the same questions that public pension allocators would ask, but it's really important to know that we are not allocators, right? And so we don't have large pools of capital that we have to put to work and rely and, think about the retirees and, the liquidity that exists there. And so our job is to help our nonprofits exist in perpetuity. And so when we're getting to know managers, we're just looking for, again, you to be different, see what your background is, see how you got into the space, but just talk with us. And then immediately after that, it generates a 2-page manager meeting note that we upload to the entire team, including our CIO reads the manager meeting note. Then we keep taking other meetings, but it's important to know about our process. It's really important to know that our clients are on a quarterly schedule.
Know about the process.
Know about the process. And Going back to the pension plans, first of all, they provide a great example because they list literally everything on their website, including some of their manager meeting minutes. So you know exactly what their investment philosophy is, what they will and will not invest in. So you have to know your investor. Switching back over to the crucial type of investor, know what our investment philosophy is. And I'm happy to, walk you through that. We're long-term investors. We're not short-term oriented, but for purposes of this conversation, private equity, particularly venture, it's a long marriage. It's 10 years, right? Plus maybe 2-year, 3-year extensions. And so what's your investment period like? When you're calling capital too quickly, too often, we want to wrap our heads around that once you do make it through our process. But just backing up to getting to know managers, it is a process. You can't rush it. You can't rush the fact that you want us to be in your first close because you want others to see who's in the capital stack. Our diligence takes time. We pass you over to other parts of our process, such as our operations due diligence process. Then we have to go through legal review. Then we have to talk about it to the team. If we're underwriting a manager as an analyst, first of all, the analyst has to like the idea. They have to be interested in the idea. Me and Akil, we talked about this on our prep call. If I'm not interested in hair care extensions as a white bald guy, I don't care about those sort of positions in your portfolio or those portfolio companies. And I also want to double down on something that Akil said. Diversity begets diversity a lot of times. We hire people that look like us. So when we look on a granular level at the portfolio, I am really excited to see the impact that is happening there with respect to the disparities and the social ills that many of our diverse managers are solving in our community. But you don't have to be a solely focused diversity fund investing only in Black people. If you're looking for alpha, you can do that in many ways, and diversification really is key. So whether you are or aren't solely focused on diversity and getting Black companies or Latino companies in the portfolio, that's fine. Just walk us through what you're doing. But it's really just talking us through, how are you thinking about a lot of things? And investment memos are really important because you can't get everything in a 1 hour or 90-minute meeting, or maybe 2-3 meetings. When you write things down, we love reading investor letters, what you think about the capital markets. Know your space and your sector. And, from there, we just keep iterating and meeting. But I would say overall, our process takes we can get the work done in about 3 to 4 months.
Wow. Yeah. It's, I've heard, let's stay in touch and let's do fun too. So that's revitalizing. I know at least you could have a decision. Akil, any thoughts on what the relationship building process was like for your group? I know your group was pretty aggressive, but as you're thinking about, that old group thinking about institutionalizing the business, there's one thing to come up with a first time, X $100 million strategy, and then, okay, this is principal money. How do we do this programmatically? What was the sort of the strategy for developing relationships, and how should we think about developing relationships with investors like that?
So the first thing I would say, just overall in our process, I've done deals in as quickly as 4 weeks. And so I'd say the average I would say is between 8 to 12 weeks for the overall process. And again, being a bank, deep pockets, we have a full internal counsel team, full external counsel team. So for legal reviews, which usually takes a bit more time, it's a bit quicker for us. And that's why, just our overall process is a little bit, shorter than the average. In terms of just the overall relationship, again, I guess the first thing we look at is what differentiates you. Help us understand alpha. How do you get to that point? And you can only discover those things truly via interviews. So in the process itself, besides the introductory interview, besides your pitch deck, we definitely have a quote unquote script where we kind of understand what differentiates you and your method of pretty much generating alpha. What do you look for in companies? Where do you look for these companies, etc.? The other thing in terms of the overall relationship is just initiative. we have some deals that, you know, people come to us and they're excited and they expect us to push it along. You know, just generally just taking that initiative, like follow-ups, let's meet in a week, let's meet in 2 weeks, not necessarily being aggressive, but, you know, kind of taking charge of the process. Those are some things, which is a little bit new, a little bit nuanced, but these are some of the things that we actually looked at. And having overall just a general buttoned up process from a legal and a financial perspective. After that initial discovery meeting, you know, we kind of communicate with these funds. These are the things we need. These are the things we expect. Given that we're a big bank, highly regulated, there are certain exceptions that, you know, the things we can't invest in. Funds have to be majority 80% concentrated in the US. We can't invest in certain sin stock, etc. So these are some of the things that we look for overall in a fund. And other than that, you know, it's really and truly, as Angela mentioned, just understanding the people behind these funds. At the end of the day, if you're investing in a VC, is investing in a manager. You're investing in a person.
Yeah.
So we actually want to know, again, what drives that person. How do they expect to deliver alpha? You know, they have a proper understanding of that space from in the risks perspective, the future trends, existing trends, you know, the competition in that space, or a proper understanding of that space.
Thank you. The other thing is, I'm talking to someone that could potentially be an anchor in my fund right now. Last year, he launched an emerging managers fund for new managers, and it took him 2 months to raise capital for that. And he already had he does emerging manager research. So he already had he's been doing it for years. He manages $8 billion. He already had fund managers lined up to invest in. So all that money was deployed by the end of the year or the first quarter this year. And it was so successful, he decided to launch the Emerging Managers Fund 2. Now, something happened between when he decided and when he launched. The big thing was the capital markets, particularly the equities markets and the liquid markets, started to come under pressure. And a lot of his investors are pension funds who have legislative requirements to balance their private investment portfolio with their liquid equity and bond or debt portfolio. And what you saw was all of a sudden their privates and alternatives and venture portfolio is disproportionately larger, and it's breaking through their threshold, so they can invest. So this guy manages like 8 billion. So I said to him, are you having a problem raising? And he goes, yeah. I'm like, is it hard for you after 10 years, $8 billion? He goes, Boris, it does not get easy. And I'm like, bro, I need you to raise this money because I need my anchor. But the capital markets has impacted him. I used to be a capital markets guy. I haven't been looking at the markets. Is it impacting your clients or your investment strategy in terms of their overall asset allocation? Or is this a good time for us with regards to fundraising? So the question really is, what are some of the impacts from the capital markets on the environment for us today? And I have to sort of.
Yeah. So speaking with my clients, one, fundraising is a challenge now for exactly the reason you said. One, portfolios, raising money from an institutional perspective, not necessarily us, but if you think family offices, pension funds, etc. There was a lot of money that went out the door just about pre-pandemic into the pandemic. And if we look at valuations at that point in time, valuations were sky high. So, valuations were sky high and continued climbing. We're at a point now where, because of those, I would say, unrealistic valuations, and that's clearly my opinion here, we have that unbalancing of the portfolios. We're currently through what I call a great rebalancing, not necessarily a recession, where things are starting to look a little bit more normal. So despite, as an example, unemployment numbers being up, we always hear Walmart and Apple and Peloton, letting people go. And it's because during the pandemic, there was a large ramp up, and not just in hiring, but in valuations as well. And we see those things kind of normalizing now. given that sense of normalizing, Fed minutes just came out yesterday. They may slow down overall rate hikes, etc. A lot of the macroeconomic environment dictates there's a little bit of uncertainty. And that uncertainty, whenever there's uncertainty, it obviously belies that, hey, we're not exactly certain what we're going to do going forward. So let's kind of pause. So whereas they have expressed a lot of funds, have said, yeah, we have a lot of soft commitments. Those, until there's a little bit more certainty, those soft commitments don't become hard commitments.
Oh my God,
that's purely
about soft
macroeconomic.
commitments. That's another topic in general. Those are commitments you got to firm up to soft up like constantly, because soft commitments three weeks ago or a month ago could all of a sudden be gone commitments. So that's something else to talk about.
Correct.
Yeah.
And the soft commitments, I would say, aren't, from a LP perspective, it's hard to really transition soft commitments into hard commitments. I think it's more so an internal decision in terms of, okay, do we feel, not necessarily do we feel comfortable, but from a macroeconomic perspective, from a strategic perspective, from a portfolio balancing perspective, is this something that, you know, would benefit us? And then it's all about timing. So the soft commitments, from what I've heard from 10 to 15 of my funds, that's where they, you know, pushing that over the line is where they feel a little bit vulnerable. And what I would say is it's usually based on, I guess, the macroeconomic environment, the firm's strategy, where their portfolio is. There's little you can do, but, you know, some of the things we mentioned before in terms of the overall relationship and, you know, the ability to navigate, I guess, macroeconomic uncertainty and a proper understanding of the economic variables that may impact your business.
Angela, any thoughts on how the capital markets will impact us right now?
Capital markets are very efficient, is what we always say, right? But you know, something reminded me of a conversation that we had probably over a year ago. The denominator effect is real, and when that occurs, the value of the portion of the portfolio decreases drastically and pulls down the overall value of the portfolio. So when we see that, we were, you know, you look at the private investments, and you know, it's illiquid and it's a long-term view. But when we see the denominator effect happening, we worry about that because it actually gives a lot of our clients purchasing power to invest in things like private equity, right? So we always focus on giving our clients purchasing power. And if they don't have that purchasing power and the ability to have that liquidity, especially when spending rates are high and all these other things are going on with these institutions, this is one of the reasons why venture capitalists or private equity managers in particular have a hard time getting access to capital. We simply don't have the capital to allocate, you know, depending on what's happening in the capital markets. There's a few things that I want to touch on that was said earlier. You know, a lot of managers, you know, when we're in meetings, they talk a lot about soft commitments. We care nothing about soft commitments. You can mention them, you cannot mention them. What counts at the end of the day are the hard commitments. And again, we're not the type of LP that will sit on the fence. We really don't care who's in, who's out. We really vet you and look at you as a fund, you know, and as an individual, as someone who is ready for institutional capital or not. So it could be a no, it could be not right now, but I promise you, especially Angela Outlaw Matheny, I will always give you critical feedback to see what we need, you know, where we need to be in the future, what you need to do. You really need to just get your reps, a lot of non-traditional managers that I'm coming across, in order to be ready, us to be ready for Fund 2. But to keep talking, keep engaging. Realize a lot of managers rely on fund of funds, but fund of funds have a tough time, some of them, raising capital as well. And so if you're looking for them to be your anchor, if they don't raise their fund, then, you know, that reliability on that capital, you know, it could really, really tie your hands. So we understand that. But the problem with fund of funds with us, or not the problem, but a lot of our clients they worry about that extra layer of fees. So we rather go direct. So we rather have direct relationship with fund managers. And the other thing I want to say is that if you're a networker and you don't have an edge, if you don't have control, if you're not really leading deals, no one wants to pay a 2.5%, 3% I've seen for a management fee for a co-investment, a fund that's really leaning on a co-investment strategy, sort of riding the coattails of other investors and not having a point of view and leading deals. And then we look at, the equity stake that you have in these companies and your pro rata rate, how are you going to protect that? There's a lot of moving parts, but in my work, I love to break all of that down because it's really about what you don't know.
I want to move to networking right now, but before I open the networking, you said something about getting your reps in. Could you just clarify what that means? I think it's an important part that people don't appreciate.
Yeah, getting your reps in essentially means being allowed to make mistakes and learn from them and talk about the lessons learned. You can actually share that with investors. We want to hear that. We want to hear, white people, white men, they have gotten a 400+ year start, right? Why aren't we allowed to get our reps and make mistakes and have lessons learned? And so a lot of times, your fund one will allow you to do that. There's one thing to build a firm and then another thing to build a fund, but you have to do all at the same time. And again, we love operators. And so getting your reps is actually rolling up your sleeves and executing the strategy.
Yeah, I like to talk about or point to the fact that our guy that started WeWork and had a disastrous exit from WeWork. He, although SoftBank turned things around a little bit, he's back at it, right? He's not to fail, and, raising money again. Yeah, I don't know what he's doing now, but he gets to fail up. Anyway, Akil, Angela, thank you so much, guys. We're gonna have like 10 minutes of quick networking, so we get to talk a little bit to each other, exchange information. But up next is the U.S. Treasury Department and SSBCI funding and how states are going to be distributing that funding. So we're going to have the Empire State Development from New York talk about that. So we have more programming coming up. It's going to be fast and furious, just like this panel. So stay tuned. And if you guys want to stay on, Angela and Akil, to be placed into these networking rooms too, would appreciate if you could do that. So I'm going to do the breakout right now.